Hi, everyone. Dave Schiller here with Aegis Wealth Partners. I'm a CFP financial planner. I'm also an enrolled agent, and I have a couple of designations in college planning and student loan repayment. Today, I wanted to talk about PSLF and getting ready to resume student loan repayments here in October. So I just wanted to go over some of the basics of the PSLF program and a couple of the changes and some things that you should probably be aware of as loan payments begin here in about a month. So let's review the basics of the PSLF program. You have to make 120 qualifying payments. They have to be in an accepted repayment plan, and you have to work for an eligible employer full-time. So the eligible loans for the PSLF program are direct subsidized, direct unsubsidized, direct plus, and any direct consolidation loans. If you're unfamiliar with the difference between a subsidized and an unsubsidized loan, I do have a video describing the differences between the two. So you can check that out on our YouTube page or also on LinkedIn where I have that posted. Now, ineligible loans, this is important. So there may be some older borrowers out there who still have some student loans. Those would be FFEL loans, Perkins loans, you have Parent Plus loans, and then private loans. So if you have a FFEL or a Perkins loan, you can do a direct consolidation and access the different income-driven repayment plans. For a Parent Plus loan, if you consolidate that into a direct consolidation, you can go into what's called the ICR plan. But if you want to access the more robust, really friendlier plans financially, you'll have to do a double consolidation. Double consolidations are pretty complicated. There's a lot of steps. And so if you are thinking about doing a double consolidation with a Parent Plus loan, really recommend that you talk to somebody who has experience doing it because it can be quite complicated. And then private loans, they're just ineligible for PSLF. Never have been eligible, never will. Now, qualifying repayment plans. So I mentioned a couple of them very briefly, but what are the qualifying repayment plans? The standard 10-year repayment plan. A little bit not so useful to most borrowers because if you have 120 qualified plans and you do the standard repayment plans, by the time you get to your final payment and you make your last payment, there's really no balance left. So it's not very helpful in terms of loan forgiveness there. But we have the IVR, the ICR, pay, repay, and the SAVE, which is going to replace the repay plan. I'm not going to go into details on the different plans. Just know that there are multiple different plans. They all have their different characteristics and benefits. But these are the repayment plans that are eligible for PSLF. And all of these IDR plans are anywhere between 240 and 300 payments. So it's 20 to 25 years. Now, for PSLF, it's not really that relevant because if you make the 120 payments, then you can get loan forgiveness. The 240 and 300 payments, those are really geared more towards borrowers who are looking for loan forgiveness, but not PSLF. And then you have to work for a qualifying employer. So that will be US-based government organization, state, local, federal, could also be tribal, US military, nonprofits under Section 501c3, and then certain other nonprofits that are related to public service. So unions, for example, partisan political organizations, they are not eligible for PSLF. And then you have to be employed full-time, so you have to work at least 30 hours. And if you do have more than one job, let's say that you work 20 hours for a nonprofit, 501c3, and then you also work 10 hours for another 501c3 nonprofit, you can combine those hours and that will count as full-time. And for elementary and secondary school teachers, you have to be working for at least 8 months. And then just to get a little technical in terms of time off, PTO, FMLA, paid vacation, all of that time will count towards PSLF. So to recap, what a qualifying payment is, it's 120 payments made while you're in a qualified repayment plan, working for an eligible employer and full-time. And so you make those 120 payments with all of those qualifications, and that should get you into loan forgiveness. You do have to do your employment and income verification, of course. But as far as the qualifying payments go, these are what you need to know. Now, as we get into repayments in October next month, just some of the things to understand about making post-COVID payments. I've said this many, many times in previous videos and elsewhere. If you haven't done it yet, you should verify your loan servicer. Now, for PSLF, Mohila took over the PSLF program a little over a year ago, but you want to reach out to Mohila and make sure that your contact information is correct. If Mohila was not your servicer, you want to make sure you can, get your login credentials. Just make sure everything is correct there, because if they need to get it in touch with you and they're unable to, there could be some pretty nasty ramifications. And just keep in mind, as I've said this elsewhere, loan servicers have cut hours. They're not providing weekend hours, and they are not prepared for the wave of borrowers who are going to start reaching out next month. We have tens of millions of borrowers who are probably waiting till the last minute and are going to reach out to their loan servicer at that time. The loan servicers are really equipped, and their capacity is only a couple 100,000 calls a month, and it's going to be up to tens of millions of people doing it. So do not wait. Make sure everything is correct. Now, one of the things you'll need to do is verify your employment. This is something that that if you're in the PSLF program, you're working towards public service loan forgiveness. Besides income verification, you also have to verify employment. So I do have a one-page checklist that you can reach out to me and get. I'll leave something in the comments where you can grab that one pager, and it will go through the steps for electronic employment verification. So why is this important? For those of you that have never had to make loan payments before, this will be normal for you. This will be the first time you have to verify income. So to go through the process won't be that big a deal. But for those people who have gone through, or who are in the PSLF program and have done it, employment verification in the past, Mohila has instituted an electronic employment verification process. So from my discussions, I still don't think there's a lot of employers who really understand this or who are really aware of this. I think there's a lot of borrowers in the PSLF program who are not very aware of this. So, if you need help on understanding how to work the electronic verification process, again, you can reach out and grab that one pager, but you also have to make sure that your employer is on the same page, because they're going to be part of this. There's two parties, and they have to have their infrastructure in place to do this. And then, check your PSLF credit. During the forbearance that we've had during COVID, this will count towards loan forgiveness. So, make sure when you log into the servicer that they have that updated. They may not right now, so it just depends on your account, but that's something that will be available for you to check. And then in general, you're going to certify your income annually. We recommend that you certify your employment annually as well, but also when you change jobs. And as I said, don't forget income verification. These are two completely different steps. And as someone in the PSLF program, you have that extra step of having to verify employment as well. So some considerations that you should know. Again, this is, I think, really geared towards people who have had to make payments in the past. Should you certify your income early or wait until the deadline next year? Really going to depend. Has your income increased or decreased since your last payment? That's going to be, I think, one of the bigger drivers of why you would decide to certify early rather than wait. And then what method are you going to use to verify your income? Are you going to use your tax form? Are you going to use a W-2 or some other method of certification through your HR department? And then have your family circumstances changed? Are you married, divorced? Do you have kids? Do you have more kids? Are you expecting an expected child? So not yet born. That's an important consideration and something that will impact your discretionary income. And then what about your tax filing status? So I think for most married couples, they'll generally file jointly. There's a lot of benefits to doing so. But when it comes to managing your AGI for student loan repayment, sometimes filing separately when you're married makes a lot of sense. It can make a really big difference. And so you have to take into account, if you are married, should you file separately? And again, you're going to want to consult somebody who understands what's really driving discretionary income as it relates to student loans, and what are the things that you're going to lose? What kind of deductions, credits will you lose, and some other considerations. So it's an important thing to think about, and there are definite pros and cons to doing so. But if you do it right, it can pay off in a big way. And how should you lower discretionary income? Now, this is aside from your tax filing status. Does increasing your retirement contributions help? How much should you contribute? How much additionally should you contribute? To what type of account? Is it going to be Roth? Is it going to be traditional? You really need to know which of these questions to answer. You need to know whether Roth or a traditional IRA or 401k contribution is going to help. And then where are you in your tax bracket? So not what tax bracket are you at, not what your marginal tax rate is, but where in your tax bracket are you? Are you on the lower end of it? Are you on the higher end? This is important. And then should you make a Roth conversion now? There's a lot of talk about Roth conversions, but how does a Roth conversion impact discretionary income and ultimately your monthly payment going forward? So there's a new income-driven repayment plan called SAVE. I am going to talk just a little bit about it, very high level. So the skinny on the SAVE plan. This is going to replace the repay. If you're in repay now, you don't need to do anything. You'll automatically be moved into the SAVE program. And as the SAVE program really begins to take shape and all of the benefits start to hit that plan as they're rolled out, then you'll automatically receive those benefits. You can enroll now if you're not in repay or SAVE, but many of the benefits are going to start next year. And again, this is not a comprehensive list. I'm not going through everything, so just be aware of that. So this summer, what are we going to see with SAVE? This is really big. Discretionary income, your income protection, is going to increase from 150% to 225% of discretionary income. So this is great for people who are on the lower income levels. You may find that you don't have any monthly payment due. And then any unpaid interest will not accrue if you're making monthly payments and you're making them on time. And again, married borrowers, you can file separately. Again, if this makes sense, this was not allowed in repay. And that's, again, it can be a really big game changer for some borrowers, depending on how their finances and their income is set up. But for repay, while it was not allowed, you can file separately and exclude your spouse's income. And next year, what we're going to see is discretionary income is going to drop to 5% of discretionary income. For undergraduate loans, it'll be 10% for graduate loans. If you have a mix of both graduate and undergraduate, it's going to be a blended rate based on the percentage of loans in each category. And then loan forgiveness for small balances. If you have a balance of $12,000, not a balance, if you have $12,000 or less when the loan was originated, then the remaining balance will be forgiven after 10 years of payments. And then there's no consolidation penalty. This is really big. One of the trickier parts of helping people with student loan repayments and income-driven repayment plans was if you would do a consolidation plan, any progress that you had made towards forgiveness, whether that was PSLF or just your standard forgiveness for non-PSLF borrowers, it would wipe you out and put you right back to zero. So that's not going to be the case going forward here with the SAVE plan. And then tax integration. Now, this is going to apply to all of the IDR plans. This is not just specific to SAVE, but you can give Ed access to your IRS records. I had mentioned this in the past on a past video where for college planning, we're really moving towards IRS and tax integration, where when you're filing the FAFSA, your tax records are going to be automatically included. It's not quite the same, and there are they are different approval. That you have to get different approval. It's not just you do it for one and you get it for both. They're different processes. But so do you want to do that? One of the benefits to doing that is that your income is automatically certified every year. So you don't have to do anything. It's simple, and but what it does do is it really is going to make your tax planning that much more important, because you want to make sure that you don't do something in the course of the year and then file your taxes, and then your discretionary income is higher and therefore your payment's higher. So you really do need to make sure you're going to be really focused on tax planning more. And then if you leave an IDR plan, and this is except if it's the IDR plan, because you no longer qualify for what's called a partial financial hardship, the interest will not be capitalized, and that's a really big thing, more so for the non-PSLF borrowers, because for non-PSLF borrowers, the forgiveness program is a taxable event. For PSLF, if you have $20,000 that's forgiven, PSLF, it's not considered a taxable amount. So again, it's still a big deal for many student loan borrowers. So I hope that helped. There's quite a few things that I covered. One was just some of the basics of the PSLF program, along with some of the new changes to PSLF and employment certification. And then I got into some issues with taxes that apply to both PSLF and non-PSLF borrowers. But I'm here to help. I'm here to answer any questions. So you have my contact information there. You can always reach out. Happy to set up a time and answer your questions. But again, hopefully this helped. Hopefully this cleared things up a little bit. And we'll catch you on the next video. So thanks for watching.